Now that we've covered some of the high points of the currency markets, let's dig into some of the detail with Bob Iaccino, founder and chief strategist of Path Traders. Welcome to the show, Bob. How are you doing this morning?
Good. How you doing, JB?
Great, Bob. So I started off the segment talking about U.S. dollar because I feel like any currency conversation pretty much has to start with the U.S. dollar. It seems that we regained a little bit of footing from last week as we sold off. We've moved up past what I sort of call that psychological $95 level. But when I'm looking at a market like today, which has had this huge sell-off, I kind of expected a little bit of a bid coming into the U.S. dollar that would maybe give enough momentum to push it up past that 96 that we saw back in the beginning of August. What is your take on it?
Well, I don't think you're wrong to expect that, JB. That's sort of classical knowledge, right, where the flight to quality tends to head into U.S. dollar-denominated assets, specifically the treasuries, and by default, the dollar. But it's a little bit different this time, as happens when the U.S. is part of the problem. And by problem, I just mean that the flight to safety or flight to quality, which in this particular case would be a return of your money as opposed to a return on your money, would go into treasuries, but not necessarily the dollar, because the fundamentals around what's causing the sell-off, the fundamentals around what's causing the yields to head slightly lower in the U.S. are dollar bearish. They're potentially going to give the Fed an excuse or a cause to pause a little bit in their rate hike path, which would mean a little bit more freedom in terms of dollar supply, a little bit more monetary looseness, so to speak, and a little bit extra dollars in the market. So you're seeing it in the yen, you're seeing it in the Swiss. I think it's probably correct that you're not seeing it by any huge measure in the dollar, but we're also not seeing a massive sell-off. I would call this kind of the unchanged line right here, as long as we stay above that 95 level you mentioned in the index.
So, Bob, before I move into some of the other majors, I think I have to take a moment and talk about the yuan and the U.S. dollar, because much of the pressure on the Chinese economy has been at the hands of this strong U.S. dollar. We've already seen Chinese officials intervene 4 different times this year as the yuan continues to be squeezed by the dollar. But again, sort of as we said a second ago, I was looking at the numbers last night, and actually the yuan actually edged up a little bit, about 0.2% against the dollar, still just above where it's been at a 21-month low. I guess the question here is some of the information that we're getting out of what the plan is for the Chinese government, do you see some of the pressure on the yuan being relieved, or do you think that if this dollar continues to climb, it's going to kind of put its foot back on the yuan?
Yeah, I think the yuan is definitely focusing on the G20 meeting, the sidebar meeting between President Trump and President Xi Jinping. We saw the sort of light confirmation of that meeting from the Hong Kong newspaper last week. And China right now is a sentiment story more so than an economic data story. The data's out. The GDP has been slowing, but it's been slowing since 2011. We had a little bit of stabilization in Chinese GDP around July of 2017 or so, where it kind of flatlined around that 6.8, 6.9% level. And then we got another 2-month dip, or 2-quarter dip, I should say, over the past 2 releases of Chinese GDP. And then that sentiment rally that we saw in the Hang Seng and the MSCI Asia Pacific Index that came off of that Hong Kong story. So I think in China, it's a little bit more of sentiment. Also, Treasury Secretary Mnuchin saying they are not a currency manipulator, not at this point. So that, I think, all added to the basing of the yuan. Again, it's a little bit of a side story, but no, I don't think we're going to see any relief unless we see relief in the trade tensions. Again, that's kind of what that story was giving the Chinese consumer.
All right, Bob, so I'm going to turn a little bit over to Europe, and I follow you on Twitter, and so I watched your Twitter feed, and yesterday I was watching as you talked about the euro, and clearly it felt as though that euro was feeling a lot of pressure from the strong dollar, but also for this Italian government issue, specifically where the EU rejected its debt to GDP ratio, and then yesterday was the big due date of what was going to happen if they were going to abide by the ruling. What I saw was they said they were going to abide by the ruling, but what I'm wondering was, has that given us the bid in the marketplace, or is it this ECB meeting that occurs on Thursday, in which Draghi is expected to say, hey, guess what, guys, still no change in rates? I'm wondering which one of these is the bigger story of the bid into the euro here.
I think the bigger story is Italy, and I'm going to have a little fun with this, JB, being a first-generation Italian-American myself. I'm pretty familiar with the culture. I speak the language, and they can be stubborn. This is a story of fiscal responsibility versus national sovereignty. The government that was elected in Italy recently is populist, and I think, honestly, they're taking a little page out of the President Trump playbook where they're just threatening. They're saying, no, we are not going to budge off of this. The Chinese government, specifically the ruling government, the Five-Star Party as they're called, that's the populist government, is saying we are not budging on this one. They're going to try and force the EU to reject the budget and send it back. Now, by the same token, they're talking on the other sides of their mouth by saying Italy needs to stay in the EU. Italy's a critical country. And from an sort of an optics viewpoint, I agree with that. Italy is critical. Economically, Italy's not necessarily critical. What they're trying to get is a little bit of leeway to allow them to put this new plan into place, which they say is going to produce growth. What it doesn't give the EU is any sort of assurances as to what they're going to do if that growth doesn't come through. So I really think the Italian story is the biggest story in the Euro. I think that they continue to dig in on the government side. The budgetary side, they're saying we might take it back and look at it again. But the government, the ruling party, is saying, no, we're not doing that. This is our budget. That's going to be a little bit of a headwind for the euro going forward.
All right, so that makes a lot of sense, and I definitely agree with that because I'm curious to see what will come out of Draghi, but I don't think you're going to get much, so I definitely can see where the Italian government has a bigger play here. I want to flip across the pond, and I want to go to the pound, and I think there was an interesting story about a potential no-confidence vote that came against Theresa May. Suddenly, you see a little bid into the British pound, but again, that goes back to the question of Brexit pressures. You know, really, should we be expecting to see this little bid up in the pound here if there is true Brexit pressures and this no-confidence vote comes to play?
Well, if the no confidence vote comes to play and they actually vote no confidence, now we've got elections, and with that election, there's the slight possibility, I'd give it about a 15-20% chance of a new referendum. We saw the protests over the weekend, and those were pro-EU protests, that the UK needed to stay in the EU, and the Brexit process has been a disaster. So you can see the polls shifting into this sort of stay mode. It would be interesting if they could just referendum after referendum after referendum until some sort of deal gets done to where they're either going to stay in the EU or they're going to actually have a Brexit process. Again, this is a nightmare for Mark Carney.
So, Bob, before I let you go really quickly, we've got the Bank of Canada coming out with their potential interest rate increase of 25 basis points tomorrow. We've seen a little bit of pop in the Canadian dollar. It's come off quickly. What do you think is going to happen here? Do you think you'll see a continued pop in the Canadian dollar, or will it be just crude oil based?
I think you'll see a dovish rate hike if this is a rate hike. Canada's doing very well shipping a lot of the Canadian sands down to the Midland refineries, Midwest of the U.S. They're doing very well with that. They're able to get it out of the ground more cheaply and actually make money on this. I think we see a dovish rate hike. I think we see a hike and then dovish comments out of the Bank of Canada.
Great. Well, thank you, Bob, very much for some fantastic information and a deep dive into the U.S. dollar and global currencies today. Again, that was Bob Iaccino, founder and chief strategist of Path Trading Partners.